Welcome to the Cash Flow Project Podcast. Are you looking to better your financial situation by increasing your cash flow? Too busy to hunt for real estate deals or don't know where to start? Then you're in the right spot. Join us as we dive in and talk about investing for cash flow using multifamily real estate.
Welcome to the Cash Flow Project. I'm your host, Vince Gethings with Tri-City Equity Group. And today on the show, we have Spencer Hilligoss. Spencer is the CEO and co-founder of Madison Investing, a real estate investment firm specializing in real estate syndications and private equity funds focused on multifamily, self-storage, and niche asset classes. Prior to pivoting to real estate, Spencer held several executive roles in the Fintech industry, including positions at Intuit and Gusto, forging a 13-year track record of building high-performing teams across 5 companies, 3 of which are now valued over $1 billion. Big stuff from Spencer. Spencer, welcome to the show.
Vincent, thank you so much for having me. Excited to be here.
Yeah, absolutely. So let's get started. What was, what brought you to real estate, or tell us a bit about yourself and kind of tell us about how you got into real estate?
Yeah, so I grew up in the Bay Area. Still live here now, as we were chatting about beforehand, Vincent. So I'm based in Alameda. Not many people know that if they're outside the Bay. It's a little island right across from San Francisco in the Bay Area. I got into Silicon Valley tech companies, as you mentioned during the intro, but that was not always the plan. I mean, it's not always cool to tell your friends that you work at a real estate company. My dad was a broker for 30 years in the Bay Area. So he was a residential real estate broker. And he ended up becoming, one of the top 5 real estate brokers in the country for a time back in the 90s. So he was putting me to work, doing open houses, being a gopher for that business, even as early as a teenager. But it's not cool to tell your friends in the Bay Area that you work at a real estate company. Most people think it's much cooler to say that you work at the local tech company, or like the hot new startup or the unicorn. And so that was the path that I went to out of school. And, certainly never expected that to kind of become something that was a more leadership track. So I ended up building operations and sales groups for 13 years, stumbled my way into a real estate tech lender. So they were a tech platform, and also ended up being the biggest hard money lender for fix and flips in the country. That was Lending Home. They've rebranded since. They're called Kiavi now. But yeah, so I ended up becoming a mortgage loan originator because I had to train other and grow other mortgage originators. And we ended up doing 600 deals per month, fix and flip loans, and $4 billion in originations before I left. So that was like boot camp on the real estate investing stuff. Nights and weekends, started buying rentals because that was the light bulb moment for me. I was like, wow, we need to get some more income streams here. And ultimately, won't bore you with stuff, but there was some pretty tough times we had earlier in life with my dad's business that taught me the lesson of like, don't rely on one income stream. So applied those lessons, bought some rentals, grew out of that stage quickly, learned why it's not as fun doing rentals, and it's way more fun doing passive investing in private funds and syndications. And here we are today, somehow, fortunate enough to run a group where we actually help other people go through the similar path that we did, where I left my job behind in 2019, my whole career behind, and retired from that career, and now do this full time and just have a blast. I get to wake up and help other people invest similarly to the way that we did. That helped us ultimately move on from that W-2 career.
I love it. Great story. So you did the loan origination at, what was it? Kiavi? Is that what you said it was?
Yeah.
They weren't named
at the time. Right. Yeah. At the time they were Lending Home. Now they are Kiavi.
Okay. So at Lending Home, how has that experience of being a loan originator help you transition when you started buying rental properties or getting into even the commercial stuff? Did it give you kind of a competitive advantage? Because I think it would, kind of knowing what that side of the house looks like in a transaction.
To say it was helpful was an understatement, right? It was a remarkable journey for me. I mean, I was working at companies handling dry back office stuff, like the stuff that will put people to sleep. So I will not do that here for your audience, but I will say that payroll and accounting software, from companies like Intuit, great companies. I'm thankful to have been there. They do TurboTax. If people don't know QuickBooks, those are important problems. But on the lending side, I was inside the guts of this lender, and I myself was not originating. I had to get licensed as one, and I had to learn what the role was, but that was because we were hiring and scaling the origination groups across multiple states. And so I was the guy in charge of having to grow to that $4 billion number. And ultimately, that was really eye-opening. I mean, we're talking about 13 years into a career, happy with the W-2 income we'd been making at our household. You know, Jennifer, my co-founder and CEO, as well as my wife, she had her own career. So we got a dual income household, retirement account structures, all those things. But the net worth number wasn't going the way that we wanted it to over time. You know, and we're sitting there going like, what's the catch? We had 2 young kids. We're working 80 hours a week in an office. You know, it's a challenging dynamic to witness. And so in the guts of this lender, I'm seeing the zeros on these transactions, like the number of zeros, to be clear, like how much that some of these very experienced flippers are making one transaction. Mm-hmm. And we're talking folks that are running in parallel dozens of flips across the country at one time. And then you've got, of course, we would also help the first timers who just watched HGTV for the very first time, and good on them. I cannot swing a hammer. So this is a no judgment comment. I cannot flip, and I don't flip because I know I would hurt myself. But seeing how much these folks were making on these deals, it was eye-opening. You know, it was eye-opening to see the potential financially on what folks could do. And these are scrappy folks that self-educated themselves in the world of business, and they became flippers. And so I was like, it lit the spark for me. So I just started devouring educational content, podcasts like yours. You know, on nights and weekends, I listened to 400 podcasts over the course of a year and a half. I read 24 books. This is all while having a day job and managing and leading and hiring others, and waking up at 4 a.m. to do all that before I got my kids ready and went to the day job. So that was more than you asked about, but just to kind of give you the color, like that was the spark for me, was like seeing how much success folks could have on the other side, seeing those transactions. And of course, also knowing like, how do you structure a deal from an LTV perspective? Like, what's the right balance? Like, how do you make a credit-based decision? How do you underwrite, at least from a residential perspective, before I later went and focused on the bigger deal stuff? Frameworking is the key takeaway though, Vincent. I mean, I got to say that if my tech career gave me anything from an education perspective, besides network, the power of frameworking. And that just means like making a great decision is typically done slowly. Mm-hmm. As you know, like as an active player in the real estate world, like great decisions cannot be made slowly when it comes to deals sometimes. And so like, how do you make these decisions quickly and well? And frameworking is how I've decided, from pulling out all those learnings from the tech career and from being inside the guts of a lender doing 600 loans a month. That's how you do it. And so we look at things like when we're looking at people to work with, we're looking for a 5-part framework. You know, we're like track record, approach, team, communications, and even values. Like that's the nerdy kind of stuff that my brain comes up with when we're just trying to ensure that we do the right structures and the right deals to put in front of our own investors and put our own money in with these teams as well.
Love it. So you got framework out of it, which is like almost like a checklist, kind of like of how you make a decision, like a decision-making tree, I guess, right? Like it's kind of like what it is. All right, got it. That's very helpful. And especially if like, you know, a lot of people, when they are first getting started, like you said, you started buying rentals out of the gate first. They don't know like what the lenders, boxes they need to check look like. Right. They like, I'm just going to submit an application, but I don't no idea how I look, my application, my credit or whatever my business plan looks like to the lender. And they usually get denied the first couple of times until they kind of figure out how to make the round peg fit in the, square hole, right? Or whatever it is. So so that's what I've seen kind of the first couple of times, or when people try to take down their first like 1, 2, 3 deals, is just figuring out what's that Rubik's Cube of unlocking the code to get the yes from the lender. And I feel like you probably had a little bit of an advantage there because you know the code, the cheat code of that Rubik's Cube. You know what DTIs need to be. You know what, how to structure the deals. So you're probably a lot more favorable to get approved.
Incredibly helpful to your point. Yeah, I would just say knowing what a credit box is at a high level concept, Step 1 was like mind blowing to me. I mean, as a guy who was already on his 3rd home mortgage, the purchase and a couple of refis, to go through that and be like, oh, got it. So if I fit their box, it's very easy.
Yes.
If I don't fit their box, it's a whole other track. And there's this thing called compensating factors. And so, yeah, that it's incredibly helpful.
Yep, absolutely. Well, you got any tips on that before we move on? Like, for people listening, what are some tips that you have from them based off of your entire experience in that industry to help people kind of posture themselves to fit in that box a little better when they're going for their first deal?
Yeah. I mean, I think if we're talking like residential in particular, this is going to be a little bit high level and maybe more abstract than is helpful, but I am happy to drill down if it is more helpful than one click down. But just lenders are looking for stability and predictability of income, and they're also making sure that your income specifically to the debt that you already have is a reasonable ratio, right? So your DTI, yep. So your DTI, your debt to income ratio. So I think that's huge. Also, if the person is like, for example, if they're doing their first real estate investment, and they have income, but that income isn't necessarily business income, they have strong personal income, I mean, they're still going to have their personal situation looked at very closely. That is the number one thing. The lender is going to look for whatever is available based on that person's creditworthiness, and their income and their assets. And so just get organized. I mean, like, if nothing else, I would say bare minimum, get organized beforehand. Like if you go to the lender and you come correct and you have all of your stuff nicely labeled all the way down to get nerdy for a second, even say the file names you're going to share with them, like that matters. I'm sorry, but it does. Like that stuff matters. Like, do you have W-2s? Do you have recent bank statements? Do you have all that fundamental stuff that matters? And if you're a W-2 employee, you better believe you are way more lendable still than a person who is like a rogue entrepreneur, like you and I. I mean, I think, in 2019, after 2019, when I was still in the W-2 world, but building our business on nights and weekends, we were still quite lendable from a traditional sense because we were W-2 borrowers ourselves personally. Now it's quite different, right? I mean, it's a whole other track. So I would just say that those are some of the bigger ones. Get organized.
Yeah, no, that's a good one. And, I don't want to spend too much time on this, but that was great advice. The get organized thing, absolutely. It's important because what it does is, one, it makes you look professional, and two, it reduces your response rate to lenders drastically. Like if, a lender or a loan officer is like, okay, here's the laundry list of stuff I need from you, and you can drag and drop a Google Drive folder, send it back to them in 2 minutes. They're going to be like, okay, this person knows what they're doing. And like I said, you have a Google Drive in the cloud, so it's accessible anywhere. And you got all your W-2s, your pay stubs, your scheduled real estate owned, your bank statements, all in there. You can drag and drop it, and you're like, here you go, ready to go. And they're like, okay, this person knows what they're doing. It has helped me drastically in the past, and I advise everybody to do that. Like you said, at the very minimum, get organized, and then watch your DTI. DTI is going to it creeps up on people, your debt to income ratio. You got to keep that in check. And then if you have already left your W-2, the best thing you can do is, I don't know, for me, what I did was, I have one of my S Corps, and I am now a salaried employee of my company. So I'm pulling a salary off my own company, and that's how I kind of am still a W-2 employee. So
yeah, that's right. Yeah, same here.
So, yep. Anyway, now I'll move on. I don't want to spend too much time on that. But anyway, so now you left fintech industry and you did some small rentals, decided you didn't want to be a landlord. Then you jumped into commercial. What was that specific transition there? Because I know we beat it up on this podcast kind of a lot of the small residential properties or like the single families. So I don't want to spend too much time on that part of your journey. But what I'm particularly interested in is that kind of aha moment or that epiphany you had going from the single families to the commercial. Like, what was that thing that happened that caused you to like, I need to change vector again and go a different route? And this is the route I'm going to take. This is the horse I'm going to back: the commercial, the multifamily, the funds.
Yeah, I think that's a really good question. So we got to the point of we didn't have some massive single family portfolio, just to kind of give a segue on the from. before we go to the 2. We got to the point of having 7 total properties before we decided to go and hit that light bulb moment, right? Of why bigger deals appealed more to us at this stage of life and for our current strategy than going for smaller rentals. And a couple of things played into that. I'm a big operations guy from my career, put together more forecasts in Excel than I'd ever cared to recall. And I think part of that is relevant because looking at the deals and the structures and the scale of like a 100, 200, 400 unit apartment building and thinking about the way that underwrites are done, the way that you analyze, the way you package, and just overall just cut through the deal and all the noise to look at the numbers really resonated with me when it came to how I would analyze business and just the various ways I would be involved in leadership scaling within the tech world, within the corporate world, if you want to call it that. So that was appealing. I mean, also just, in general, I think the notion of seeing one of our rental properties overnight go from 100% occupied and then having one person leave and drop that from 100% to 0 was like, that was helpful as a kick in the butt. We were getting strong cash flow from the properties that we were doing in the Midwest. We were getting like $250 a month per property in cash flow for a $60,000 purchase price. That's great. Most people would say, oh, that's amazing. And I was like, well, yeah, it's amazing unless you also have to pick up the phone to manage the manager, even if it's turnkey and you have a property manager on that thing. Mm-hmm. So we have 2 young kids, Vincent. I think everyone's at a different stage of life. And so what we realized, long story short, and I wish that I could go out there and have a one-on-one conversation with every single person who's first hitting biggerpockets.com today, for the very first time, or anyone else who's listening to their first real estate investment podcast and they're fired up. And I could sit down with them and just ask them the question, how active do you want to be? Because that's the most under-discussed question, in my humble opinion, not to say it's right. That's what people don't talk about as much in the real estate investing community at large. And so it can get confusing when people hear an asset class and we glommed onto rental because we thought it was passive. Rentals, we learned they're semi-passive and it's not a bad thing. They're just for a different stage of life. So we, 2 young kids, very demanding careers, we started to invest in these syndication structures for apartment deals and self-storage facilities as LPs, as limited partners. And I did diligence on the front end, but then I didn't do anything else after that. At least from a hands-on, hands-off perspective, I found that it was legitimately hands-off. So maybe the only other asset classes, or I should say strategies that align to a truly fully passive strategy would be like maybe note investing, like mortgage note investing in the real estate world. Or
I don't know, because I just bought a portfolio. Sorry to cut you off. I just bought a portfolio of single families to I'm gonna flip, kind of fill out my flip hopper. But most of those were notes that they defaulted on. So not passive. So what are you gonna do when they stop paying you? you still got to foreclose on them and get your house back. So yeah, I would say I don't know. Anyway, sorry to cut you off.
No, it's okay. Yeah, and we don't really focus on that, and so that's a good thing. I'm sorry to hear that though.
No, it's good for me because I bought them all. So, but the person I bought them from, that's what they were doing was note investing, and then they people ended up defaulting on them, so they became like kind of the accidental landlords that wasn't part of the business plan. And then they did it for a while, and they're fine, and then they just it was time to move on from that. That wasn't the original plan, so I was able to buy them up for a really good price.
Well, that's a good thing.
Yeah, okay. No, it was a great story. I just wanted to clarify, note investing isn't as passive as those gurus want you to think it is, right?
Yeah. And so on the LP front, we've had a very good experience, and that's kind of how we got into it initially. I think when it comes to doing diligence on the front end, it worked really well with the kind of the frameworking and just being able to go and apply the same kind of rubric and framework to de-risking as much as we possibly can. So that's how we got into it. Did not expect at the time I was going to go and dig into coaching programs. I went and learned underwriting from a commercial perspective because I knew it on the residential. I didn't really know it as well in the commercial. So we did that first, did a handful of other kind of group coaching programs and small coaching programs because I'm a believer in those things, and so that was a helpful transition to make sure we didn't hurt ourselves when it came to getting into some deals, knock on wood.
Yeah. Were these all in the Midwest? I guess I didn't clarify that. I heard you mention it, but is that where all these 7 were? All in the Midwest?
A couple in Cali, and then the rest were in the Midwest. Yeah,
okay.
in Missouri.
Gotcha. Okay, tracking now. All right, so then you wanted to move on, and then you got some coaching, and then what was that first? So you got some coaching, and then you were also an LP, kind of at the same time, around the same time. You're doing LP positions. What's that?
Yeah, around the same time.
Yeah.
Yeah.
So you're doing LP positions, then you were doing some self-education and coaching on yourself. And then you were like, I'm going to do this on my own. I'm going to become a sponsor or a provider, a GP. So what was that first deal you did of making the jump from LP to GP?
Yeah. And, I don't want to bore people too much on it. I'll just say that I was fortunate enough to be networking like a madman. So as like we were chatting about a little bit up front, Vincent, like when you just put yourself out there and you're connecting with people, whether it's on podcasts, but more importantly, just like at first getting out to conferences, maybe going out to meetups, going on every forum and Facebook group possible and just connecting with people, you run into folks. And when eventually you bump into someone and, they're doing a deal and they say, well, hey, it sounds like you're working on something similar. How would you feel if you came in and, did some work with us? And you don't exactly go in with big expectations financially on those if you do it right, in my opinion, because you're trying to just learn. And so that's how we got in. It was an apartment deal in Texas. And so I'm very thankful for that. It was still a learning phase for me, at least. And I'm very grateful. That was like a launch pad moment. So ever since that started to kind of grow from there over time, but I still wasn't looking at it like it was going to become a full-time career pivot for me by any means, Vincent. I mean, it was something I did out of passion and enthusiasm and investing for our own portfolio. And then it quickly just became like, wait a sec, folks in my network were very interested. There's a lot of active angel investors in the tech world and folks that are involved in investing, just other sides of the investing world. And they were curious what we were working on. And that it kind of grew from there into what eventually became Madison Investing, which is our investing club now. But yeah, it at first was just pretty modest and focused on the learning.
No, absolutely. And I love that you hit on the big thing in networking, just getting out there and meeting people. And you never know if you go into it without expectations. I guess the best kind of thing for networking, like when you're going out and you're doing all the conferences, and absolutely do that. Go to all the conferences, go to all the Facebook group pages, and just add value, whatever your brand of value is, whatever you think you can bring to the table, just add it without any expectations in return. And it might be months, it might be, a year until something, comes back to you. But that is so common to hear that people getting into their first syndication, especially if they're not the lead sponsor, is just like, I just showed up and asked them what value I could bring to the table. And that, I found that I had this strength that was a gap that they need to fill in their team. And I got on, and that was, like you said, the launch pad. And it is almost as easy as that. Like, just show up and provide value, and don't ask for, have expectations for what you're getting out of it. And you'd be very, very surprised at how this community you kind of receives that and propels you. So it's the same thing happened with me as well. So awesome to hear. Awesome.
Yeah, thank you.
Great. So the got into the GP, and then now what is did you have Madison at that point? Have you already formed it at that point, that first deal, the first GP deal? Or?
Yeah, it was right around that time when it was like, okay, we should probably build an actual business entity around this because this is getting more serious.
Got it. And that was what year? What year was that?
That was in like the beginning of 2018.
Okay, so 2018. So 2018, you're in the big leagues. Then where are you at now? Like, what has Madison turned into since 2018? Now we're going into Q1 22. What does it look like now?
Yeah, gosh, feel very fortunate. I mean, we in no way could have predicted this. I think a lot of folks feel the same way when it comes to looking back at the last few years of rapid growth, So fortunate enough to work with hundreds of investors, and we have a model that's evolved as well. We are LPs first. That's always going to be the case for our business, which is we go out and we're trying to find places to put our own money, like our own capital, because we believe in the asset class. It's like literally baked into our wealth building plan for our family, and tied into our goals. So that's always going to be the first move. And if we decide, wow, this working with this particular team as an LP makes sense for us, then we consider that a key step in our vetting process for the Madison Investing Club. And then we put our sponsor team that we worked with through the rest of our vetting process. And basically, we start looking at their deals, and they send us their deals on a case-by-case basis. The ones that pencil, the ones that we like, we will share those with our Madison Investing group and join with that GP team. And now I'm also registered with a broker dealer. And so that actually has been great, because that means that for folks that may not know what that means, that just means that if you're more familiar with the stock world, it's kind of like bringing the level of transparency and rigor that you'll usually see only in like the stock market, folks that are registered. So I'm registered now with FINRA and the SEC, and that's great for a lot of the high net worth folks in our group that just want the peace of mind, knowing that like we're very comfortable being totally on the grid. Everything is 100% transparent. And we just tell people like, hey, this is the deal that we like. This is why we like it. And it's worked out so incredibly well, and we're not trying to go push growth as fast as possible, but we're fortunate enough, like just this morning, our primary source of growth is referrals from other happy investors. And I just got off a phone call before our call today, Vincent, with a referred investor who had heard about us from a repeat investor of ours. So it's the kind of thing where you never quite expect where it's going to start and where it's going to go, but just feeling very fortunate on where things are headed right now. So we focus on apartments and self-storage, and occasionally some non-real estate stuff. But it's wild post-COVID world, even though we're still kind of in it right now. I don't think anyone could predict this healthy of a real estate market when it was like March and April of 2020, and there was a lot of a lot of hesitation and people holding their breath in the market, myself included.
Absolutely. So before I go backwards to the obstacles that you overcame since then, do you have any particular 22 goals, or what's like a 1-year goal for your company or personally that you want to share? Like, what do you guys do that? The goal setting?
Yeah. I mean, one of the things I think we probably take, I don't see the insides of other people's businesses, but I just know that we approach things, Jennifer and I as the leadership team for Madison, like we approach things in a very nerdy corporate way in some ways. We got the financial plan for the year. We have our big goals done this year, but looking 3 to 5 years out. And I would just say that a relentless focus on investor experience is really what we're all about. And so that is really where we listen to the feedback of our fellow investors in our group. And also, I think adjusting to what the market is telling us, because we've always been a fan, for example, when you have markets to look at, the geographical markets, you have asset classes to look at. These are things that are really, really distracting sometimes. Like they could be helpful and they're exciting, but they can also be very distracting. And our core investment thesis has been, focus on things that that we understand, but look for reasonable, predictable cash flow, and look for markets that have all those fundamentals that you already know very well, if not better than I do, Vincent, which is like, you're looking for job growth, you're looking for risk-adjusted, solid performance, all those things. And so staying focused on multifamily, staying focused on self-storage, but I would even just argue looking a bit more broadly in terms of market potential, because COVID has adjusted some of those things. Like COVID has driven some trends that are looking some more westerly markets in growth patterns that are even better now. I mean, we've been focusing more on Colorado. I used to live there, big fan of it, pretty biased toward it. Looking more toward Idaho and Arizona. We previously were focused on the Sun Belt. We did a lot of deals in Texas, North Carolina, South Carolina, et cetera. So huge fans of the Sun Belt and the Southeast in general, not stepping away from that. But I would just say that like looking even more hardcore on the places out west, but except for California. We live here. We don't invest in real estate here at the moment. But that's kind of the current focus, is sticking to what we know, because that has worked for us and there's no reason to fix that. Don't fix what ain't broken. And then continuing to lean into some of those markets that are being benefited by the COVID driven trends from a population and job shifting perspective.
Love it. Great thesis, great strategy you have there for Madison. Very excited to see what you guys do next year or this year coming up. I'm going to start winding down here in the show. We'll switch over to the fire round and get right into it. Do you have any last bit of and topics or anything you want to talk about before we hit that?
No, I'm excited for the fire round. I just say that if folks want to reach out, always happy to network and connect and try to be a resource for them. Outside of anything investing related, this is just about giving forward, paying forward. And I really believe that everything does come back around when we all do that. So it's a good time to help others, man. So if people want to reach out, I'll try to do my best.
All right. Well, how can they reach you?
MadisonInvesting.com. If they come to our website, and they can set up some time with me on there.
All right. Fire round. Same questions we asked everybody. Here we go. What is the best book you recommend other than Rich Dad Poor Dad?
I love that you put that into the fire question, by the way. Oh, that is so killer because it's so needed. Essentialism. Essentialism has got to be my most recommended book. I read it 3 times. The bullet point on it would just be, it is focused on arming someone with the stories and the learnings, but particularly the tools to prioritize better. Everyone's got the same time in a day. I mean, whether you're, Oprah, whether you're, Bill Gates, the difference is they know how to say no. And obviously there are resources they have as well. And everyone's starting from a different point on that. But the ability to say no and save face socially is the difference for most people and why they achieve what they want to achieve or not. And so that book, I just love it because it gives you really specific examples as to how to do that. And it also starts with the story about a guy picking up a phone call for business while his child is being born in the hospital. And he that was the catalyst moment for him as to why he needs to learn how to say no to things better.
Love it. I just wrote down, I never heard of it. I'm going to get it. Great book, Essentialism. All right.
Yeah.
What is your superpower?
Yeah. Superpower for me would probably be, some people think it's corny, but I would just say it's authenticity and active listening. Just like I don't have any guile. I don't have the ability to bring that skill to the bear. So it's really just, it's just me and then always being myself. And sometimes that means that I can be candid in ways that are largely productive, but occasionally stinging. But I think 9 times out of 10, that has served me very well. And active listening is in sore supply, man. Like if people really, really would benefit from focusing more on developing that skill over their career. It's like you can listen, but are you actively listening is my question to them.
Mm-hmm. No, good advice. A great superpower actually too. What is the biggest lesson you've learned over your career?
One that I have to keep teaching myself forcefully with reminders is that every single moment in interaction and business endeavor, they're all learning moments. The difference would be reflecting on the moments as they occur, whether it's good, bad, or otherwise. The reflection and then implementation of the learning from the reflection is the difference between people that progress. And so I would just argue that's got to be it, is taking the time to sit down and like truly reflect and understand what just happened. And that could be something small, like a business meeting. That could be something big, like a deal that went really well, or it didn't go so well. One of the biggest missed opportunities is when stuff goes well, all of us are conditioned to think, okay, cool, on the next. When what we should be doing is sitting there and diagnosing, well, what did I do that made that go well? And then implementing that forward. That's the hard part. And so I really believe that that's the difference maker. No,
that's really good. And for me, what goes hand in hand to that is like being aware of your ego. Because if your ego's, driving the bus, it's very hard to be aware of and have those kind of self-criticism about those interactions. So you have a bad phone call or a bad meeting, and then you're driving home and you're all mad, and with the ego driving, you can't have that self-reflection of like, okay, what could I have done better to fix that or prevent that from happening or whatever, change the outcome. So I think those two go very, very hand in hand, as losing the ego and self-reflection. You will be very well served if you have those habits. Love it.
Totally.
All right. For the busy working professional who is working toward financial freedom, what advice or tips do you have for them?
I mean, this sounds like perhaps a little bit too heady of a piece of advice for them to start with, but I would actually encourage anyone to start with this. And It might lead to more internet searches for them, but that's the desired outcome. Write down where you are, and then right next to it, write down where you want to be, and where you want to be. And I mean down to the ideal day. Like literally, what would an ideal day for you? Take out all current circumstances. What would you be doing? When would you be doing it? Who would you be doing that with? Whether it's, for me, taking my kids to and from school, that's something I do now every day. If you had told me I'd be doing that 5 years ago, I'd be like, I don't believe you. I'm never going to have time for that. That exercise is incredibly powerful. And it's powerful because it gives you the roadmap to then reverse engineer all the goals and all the plans and all the strategies, all that stuff to get you where you want to go. For most working professionals, you're sitting there and going, well, I don't want to become an entrepreneur. I'd be like, totally, I hear you. This is not an entrepreneur only exercise. This is something that allows you to then get clarity on. I mean, if you want to go make investments, what are you investing for? I mean, are you investing for cash flow? Because you eventually want to build up more income, because you eventually want an off ramp to your job 10 to 15 years from now? Or are you investing for growth because you like your career, you like your job, you have no intentions of leaving it behind, you're making outstanding W-2 income, and you just want to continue growing your net worth? Like, those are the questions that can be informed by what is your ideal day? And then everything that happens in between. That's really where the real fun starts. But I do think that exercise is quite powerful. Some folks might find that corny. I used to as well. And once I got over that jadedness, I realized, oh man, this is really good stuff.
Yeah, absolutely. And what they call it, dreamlining or something like that. That exercise where you go back and
like vision boarding. Some people call it vision boarding.
I got my vision board right here. Again, super corny when I started doing it 10 years ago. And then as I start ripping pictures off of that thing, because I keep knocking the goals out, I'm like, around the fourth year, I'm like, okay, this is a real thing. This is really happening. So it goes outstanding habits to have. The vision board, or that dreamlining of building your best life and then kind of working back from it to, time now to figure out how you're going to get there it's very, very powerful stuff. And that was great advice for everybody. So, well, thank you for having on the show. If you have any last words, now's your shot.
Yeah, well, I would just say for the folks that are out in the audience and their W-2 employees, I would challenge you to think about that you are not tied to your specific job or role, and that as you want to go out and explore other ways to generate wealth and income, just remember that the 401k is not going to save you. That was what I thought. I was very proud of dumping money into my 401k and maxing it out every single year, until I came to realize, oh, wait, I was in my mid 30s at the time when we started. And I was about to keep dumping money into something that I wasn't going to be able to use for the next 30 years without getting a penalty. How does that make sense? Mm-hmm. And so challenge someone to go get curious. Just get curious about your wealth. Get curious enough to go and educate yourself on the finance world. Even if you are a corporate finance professional, I mean more holistically. Go educate yourself on wealth building. And only take advice on wealth building from people who are wealthier than you. I would recommend that too.
Love it. Great advice. On that note, I think it's a wrap. Well, Spencer, thank you for coming on the show, and I look for bumping into you at some of the conferences this year.
Yeah, I appreciate you hosting me, Vincent. Congrats on the move, and I will think good thoughts that it heats up a little bit in Michigan, but it's supposed to be beautiful there. So,
well, it's kind of gray now, but in the summer it is great.
Cool. Well, thanks again. I really appreciate it.
That was a great show with Spencer from Madison Investing. Tons of value added. Love there at the end of the show on the fire round. Definitely some good stuff there. If you want to go back and listen to the last 5-10 minutes there, tons of value added. If you're interested in investing with us in Tri-City, definitely check us out, tricityequitygroup.com. We have like-minded investors on our Facebook group, the Honolulu Multifamily and More. You can collaborate and work and learn from us in the community. If you found value in this podcast, please subscribe and leave us a review. And if you resonated with it or feel like somebody else might enjoy this podcast, please share it with them. We're trying to grow our community here even further. Big news is we have a huge conference that we're setting up, the Hawaii Millionaire Mindset Conference, the Blueprint. It's going to be set at Ko'olina, Four Seasons, Ko'olina, Hawaii. 400 and some people, oceanside right there in the resort of Ko'olina. 5-star place. It's outstanding. We've got Disney Alani next door. We have discounted tickets right now. We got discounted room rates. We're going to have industry leaders coming and speaking on things as we lead the 2-day event for multifamily investing, short-term rental investing, buying businesses, building franchises, scaling franchises, even a little bit of crypto investing for people interested in that. So it's going to have it all. It's going to be a phenomenal event, great networking with very high-level people at this event, and bring your family along too, because it's in Ko'olina, so it's a family resort place. Like I said, there's Disney Alani. We got discounted room rates there, phenomenal rates there. So bring your family, make a vacation out of it. It's going to be July 21st to 24th, 2022. You're not going to want to miss this event. So the Hawaii Millionaires Mindset Conference, the Blueprint, and you can register at millionairesmindsetblueprint.com. We'll see you there.